The single most important question any SaaS founder should ask themselves when they're considering taking money from a VC is, does this business have a credible pathway from 1 to 100 million in revenue in less than 10 years? 100 million in revenue, because that's a manifestation of a mission. That is, we've achieved real scale. And it has 100 million in revenue. A SaaS business has a very strong and enduring correlation with enterprise value. Less than 10 years, for a couple of reasons. One is, if you're taking money from a venture fund, such as ourselves, then our funds typically are 10 years. So that's the time horizon we're looking at. But also, as we'll touch a little bit later on, if a company doesn't achieve 100 million in less than 10 years, it seems to become slightly less probable than more, which is a bit counterintuitive, I admit. Over the next few months, we're going to be sharing our 1 to 100 framework, 1 to 100 million in revenue with Notion Capital. And we're going to be sharing the fundamental building blocks and obstacles that we typically see companies meeting and overcoming on their journey from 1 to 100. We're going to be sharing our framework for how we help companies to think about the evolution of the challenges that they face. We call it start, build, and scale. And we're going to be digging into that a little bit more. We're going to be outlining the kind of core principles that underpin each of those stages. And we're going to be also, which I think is really, has been very helpful for me, and I think for many of our portfolio companies, is to help to understand the mistakes that we see companies making. And but we're going to start by just a bit of a dive in to the data. So bear with me. This is the first of 3 or 4 sessions we're going to be doing. So I started from this question, which is, look, I think thousands of the SaaS companies are founded every year, but only a handful achieve real scale every year. Is that the case? And that then begs a lot of different questions. These 5 in particular. Number 1, what is the probability of the 1 to 100 million journey? I think that's the single most important question a founder can ask themselves. Secondly, once we understand that probability, then actually what happens to all the other companies that don't achieve that 100 million goal? Because not achieving 100 million in revenue is not necessarily a bad outcome. But of course, the contract, if you like, the handshake between the SaaS founder and the VC is that's what we set out to achieve, and we believe in the possibility of that. What can we then distill from the behaviours and the common patterns, if you like, of the most successful companies? As I alluded to, are there common mistakes that we see that undermine success? And then could we use, as a VC, our understanding of those answers to those questions to better support our portfolio and the wider SaaS ecosystem? It was interesting that part of this was inspired by Bessemer Ventures, and they identified close to 99 private SaaS and cloud companies, centaurs as they call them, that have achieved 100 million of ARR within less than 10 years, and another 61 companies that have done so in 10 to 15 years. That was a really kind of useful kind of starting point. But what we did was take a bit of a step back and go back to first principles and really try and get our heads around actually what happens. So we wanted to really dig into this data set and talk about and really understand just how improbable the outcome is from a company being founded, a SaaS and cloud company being founded, through to 100 million ARR or a $1 billion outcome. That could be an acquisition or an IPO. We took a really big data set, and you can see the sources on the right-hand side of the screen there, going back to the beginning of 2005 to the end of 2022. So this is a pretty big data set, and it gives us a maximum possibility to identify as many SaaS companies as possible that have been on this, this journey. So just under 120,000 companies that were identified from the research. Just under 40,000 of those identify as being VC-backed, and just under 14,000 of those then have raised more than $3 million. Now, going back to 2005, that definitely correlates to from pretty much a Series A. And nowadays, it's more of a small seed investment, but nevertheless, we had to make the cutoff somewhere. What's very interesting from that data set is that there's less than 250 companies, it's 243, that have achieved one of three things: 100 million in ARR, $1 billion acquisition, or $1 billion IPO. So that's 1.8%, or less than 2% probability of success, of 1 in 50. What's interesting, we will be digging into this a little bit more detail later, is that, and not later in this presentation, later in another presentation, is that there is a fairly significant difference in the probability when you look at the different cohorts of VCs that people raise money from. But nevertheless, at a high level, on aggregate, 1 in 50 companies that raise more than 3 million will go on to achieve one of those three outcomes. There are a number of different ways that a company can achieve one of that 243. Some of them are centaurs, 168. Some of them are realized unicorns, IPOs or acquisitions that have not achieved 100 million in ARR. And you can see the various different outcomes here. If you download the slides, they'll be attached alongside this presentation. You can dig into this in more detail. Narrowing in on the 168 centaurs, I think is really interesting, because what it allowed us then to do is to look at how long it took those companies to achieve 100 million ARR. And it's quite extraordinary, really, that the majority of the companies from that cohort, and this is an 18-year cohort, achieved 100 million revenue in less than 10 years. That's 1.2% of the 168. It's 1.2% of all the VC-backed SaaS companies. For us, this is the important aspect of this research, because a $1 billion outcome without 100 million in ARR is far less predictable in terms of enterprise value. We believe it's profoundly important we focus in on this number, because 100 million in revenue is the single strongest correlation with enduring enterprise value that we've identified. It's quite extraordinary when you think about the number of centaurs that have achieved 100 million ARR in less than 6 years. I mean, it's simply mind-boggling to me that that is possible. Interestingly, though, the founders of Notion, who established a company called Message Labs, probably one of the single most successful SaaS companies of the noughties, achieved 165 million revenue in less than 8 years. So, we know it's possible, but the median is 9 years. And 65% of all the SaaS companies reached 100 million in less than 10 years. What's interesting also is that, as we can see from the graph, that it seems to become less likely to achieve 100 million at ARR after 10 years. The probability becomes slightly less. Now, I think there's a few very important reasons for that. One is, possibly companies are being pushed towards some kind of realization event by shareholders and stakeholders and founders. Possibly technology has been obsoleted slightly, so they get some kind of headwinds from the market. Possibly also because if a company isn't moving fast enough to achieve those kind of lofty goals, then they're facing increased competition. But what seems clear is that the very, very best are hitting extraordinary levels of scale, 100 million plus, in less than 10 years. And that is exactly what we want to focus in on the rest of this presentation. So it's interesting. So when we look at that and we say, okay, so approximately 2% of companies will achieve $1 billion outcome plus or 100 million of ARR that's been unrealized. And then we've got another 98% that don't make it. So that took me down another little bit of a rabbit hole, which was, okay, so what happens to everybody else? If only 2% of the companies that are invested in by VCs on average go on to achieve 100 million in revenue, what about the others? And I came across this data from, which was very kindly shared with us by OpenView from their survey that they do every single year, where they ask SaaS founders to self-report in terms of their revenue and time to founding. I mean, it's just one of many things that they report upon. And it's 225 companies that you can see here. And what we see is that there's some very significant numbers of companies. So we've got 56 companies self-reported who've taken between, let's say, 2 and 20 plus years with an average of 5 years to hit $1 million in revenue. We've got 40 companies out of 225 who are between 1 and 2.5 million in revenue with an average of 7 years. And we've got 50 and then 48 and 23. And what was really interesting for us is just how much that correlated with our understanding of the marketplace. I had the fortune to talk to 2 of my peers in SaaS VC, so Kyle Poyar at OpenView and Doug Landis at Emergence, and both felt that this was really a, not misunderstood, but kind of little discussed reality of SaaS that says actually companies tend to get stuck at certain milestones. And that really resonated with myself and in particular with my colleague, Andy Lever. And this quote on the top, or the comment I should say on the top, people often think of the startup journey as a continuum. It isn't. That was something that Harrison Rose, who's the co-founder of Paddle, one of our portfolio companies, which was anointed a unicorn at the beginning of 2022. He was the co-founder of that business alongside Christian Owen in 2012. And he said this to me, he said, people think of the startup journey as being a continuum. It isn't. Things change profoundly along the way. And people need to appreciate this much more clearly. And it was interesting because that really kind of inspired myself and Andy. And we started thinking about this and thinking about our own experiences with our portfolio and what we saw from OpenView. And our hypothesis is this, that there are a series of revenue milestones that represent significant changes in behavior, people, processes that are not widely understood. So you've got the 0 to 1, the 1 to 3, the 3 to 10. We're going to be digging more into this in the months to come, which we broadly simplifies down into start, build, and scale. And the people you hire, the processes you build, the behaviors you demonstrate, the actions you execute upon are fundamentally different, whether you're trying to find product market fit, establish go-to-market fit, or building scale to market fit. And we're going to be digging into this a little bit more. And the things that make you successful at one stage are not necessarily going to make you successful at the next. And in fact, possibly quite the opposite. So our hypothesis is that it is critical that SaaS founders, well, one, they understand the probability of success. 2, they understand where the key obstacles and milestones are. But most importantly, they understand when and how to transition through different stages, because that is critical to their success along that journey. So start, build, scale is designed to cut through that noise. Dramatically oversimplifying what is a very, very difficult challenge down into 3 simple steps. It is obviously possibly a little bit trite, but we feel this really resonates. So the start phase is that small number of people sitting around the table trying to figure out how to solve a problem. And I like to think about it in terms of these three ways. Can I, as the founder, answer the question to my own satisfaction that I'm solving a meaningful problem that will sustain me? Am I building a sellable product? Am I creating value and advocacy? And am I securing a modest number of customers that generalize to a very, very large market? Now, that is profoundly different to the build phase when I get into building the foundations for a big business, knowing who my very best customers are, understanding how the customer lifecycle works, and critically professionalizing and specializing my go-to-market. But that's different again when I get to the scale phase. Let's say that's at 30 million. You know, I've got to be thinking about systematization and mechanization of my growth strategy. I've got to make that growth engine hum. I've got to really know how to acquire, onboard, make successful, ideal customers over and over and over again. I've got to be on my way to dominating a category, and I've got to be exploring different adjacencies. These stages are fundamentally different. And what's more important, I think, is that the people who will make you successful in those stages are going to be very different too. Muse is a great example. We met Matt and Richard Walter back in end of 2016. I think they had about 1.5 million of ARR. They'd founded the business in 2012 to solve the problems they saw within the hotel industry of the dated and inflexible hotel property management systems. 6 years on from when we invested, actually 5 years, more or less, that business is now at or through 100 million of ARR. Conversations with Matt, the CEO, said this start, build, scale is how it played out, and I wish I'd known this sooner. We think there are certain aspects that definitely hold true throughout this journey. And kind of I focus in on three things, and I know there's a lot more we need to talk about, but I like to try and keep things simple. Like, it's only three things I really, really care about when I'm talking to founders, which is, how do you grow? Who do you hire? How do you ensure that your customers are getting value and you're extracting value? If we can't do those three things really, really well, then everything else is a bit moot. So how do we grow? Focus is paramount. Repeatability is the be all and end all across the entire customer life cycle. Excuse me. I'm on the tail end of COVID, so you're lucky I'm on this end of the webinar, not sitting next to you. The growth engine's got to become mechanical. You know, every step has to be tuned and optimized. But that is a process to build upon. I think the second part is critical, and I know we know this, right? But it's all about the people we hire, and it's the recognition that the people who thrive at each individual stage are very often going to be different. But you need to strike a balance between the people who get you through start, build, and scale, and the people who join in the build and get you through to scale, and join at scale and get you through to the IPO. It's a really hard balance to strike, but I think it's one of the most important challenges at every level of the management levels of the business, including, I think, the board. In terms of people, I think one of the most important transitions is in the build phase. So as we're building out the go-to-market fit, which is 3 to 10 million and 10 to 30, that you have to start to professionalize and specialize across the entire customer lifecycle, and you need 9s and 10s out of 10s. In the scale phase, this is something that a number of our CEOs have said to us. In particular, I was very fortunate to have talked about this at length with Nick Mehta, the CEO of Gainsight, not one of our portfolio companies, but a good friend, which is that in the scale phase, 30, 40, 50 million plus, you need true executives. you need leaders and leaders. Now, some of those leaders and leaders might be the person that joined you as the first sales leader, or the first product leader, or the first tech leader. They may well be, but the probability is they won't. And then the last point is all about value. If there's one thing that's critical in joining product and customer together, it's the monetization and the value strategy that ensures that we're focused on driving and delivering and driving consumption of value, and aligning how we charge with our customers getting value, so it becomes a win-win. And this is something that Andreas, our pricing monetization director, is very, very adamant about. You have to be disciplined on one hand, but you have to have courage in your monetization. It takes real guts. I'm going to touch on this a little bit more in the later stages, but I just wanted to share some of the most common mistakes that we see in that start, build, scale. And actually, in the next couple of versions of this presentation, we're going to be going into start, build, and scale, and we're going to be talking about the principles, and we're going to be talking about the mistakes. These are 10 general mistakes that we see companies facing. Number one is premature go-to-market acceleration. So what do I mean by that? If I'm in the start phase, the two things I think that are most likely to kill any company are, one, and actually this isn't just at the start phase, but particularly in the start phase, is one, securing and winning clients who are non-ideal and then having to churn them at a later stage. But secondly, burning huge amounts of cash and capital on building out extensive go-to-market teams before you're ready to grow, before you've established product market fit, before you've even got go-to-market fit. Second thing, we talked about it already, the wrong people in the wrong roles at the wrong stage. I believe in the capacity and capability of people within the context of a situation to do an extraordinary job, whether it's in the start, build, or scale phase. But I think what's very difficult is to transition from one mindset of start to build, to scale, and to be excellent at all three. And I think that's probably one of the most important things. Assuming product market fit in one segment implies product market fit in another. A personal favorite, and I stole this from Frank Slootman's book, Amp It Up, which is his words, the playbook reflex. So assuming that a go-to-market model that's worked in another company will work in yours, we encourage our founders to think in first principles. Design your distribution strategy that's ideal for winning your perfect customers and make them extraordinarily successful. It can, possibly should be, as unique as the product you build and the problem you solve. Another favorite of mine, like diluted go-to-market. Trying to sell to too many customers in one single go and spreading yourself too thin. Ask yourself this. If I know who my very best customers are, that buy the most, that buy the fastest, that get the most value, don't I want to deploy all my resources on winning customers just like that? And that kind of ties into the second in number 6, which is a parallel approach, not a sequential approach. I think about this in terms of customer focus, but also in terms of projects. So if I've got 5 segments and I'm going to approach them all at the same time, then I'm diluted. Whereas if I say, actually, this is the most important, this is the second, this is the third, I'm going to execute against this one first, and I'm not going to move on to the next until I've got a degree of critical mass, if you like, you can create real momentum in a business. And I think the same is true of a project focus and a product focus as well. Number 7, related to what I mentioned earlier, failing to recognize your readiness to move from one stage to the next. So trying to grow before you're ready, not growing when you are ready. Understanding where you are on that curve and understanding the distinct different stages of start, build, and scale. Another common mistake we see is pricing that is kind of rational. I've just made a cost plus decision, or based my pricing based upon a competitor, and it's done. pricing should be looking at many different aspects. It's got to be focused on value, and value is not just rational, it's also emotional. But more importantly, pricing and monetization strategy needs to evolve on an ongoing basis. Ninth, how many of us have done this, failing to understand the true scale of my addressable market? Not the TAM that you tell the VCs, but the real TAM, the real market that you can focus on. And the last one, and this is something I picked up from a fantastic presentation on this entire topic from Dave Kellogg, who's an entrepreneur in residence at Borderton. And he talked about the critical importance of addressing, failing to address, building up technical debt. It's something that will really drag your business down. We're going to be digging into these mistakes in more detail in a later presentation, looking at it within the lens of start, build, and scale. So look, in summary, I think there's a need to adapt to a new reality. And not just a new reality in terms of global uncertainty and scarcity of capital, because we deal with uncertainty, and we should be thinking about scarcity of capital at any point in time. And change is good, right, in our kind of industries. I mean, I think it's critical that businesses are able to adapt. I think what I'd really like to say is adapt to a new reality in terms of the possibility of a highly improbable outcome, which is I'm founding a SaaS business and I'm taking VC money. And my goal is to achieve 100 million in revenue, to maximize both my mission and my money within 10 years. So 5 things we'd like to really kind of end this with. One is understand the reality of that outcome. It is a less than 2% probability on an aggregate basis. Pay close attention to your stage. Really think about internally all of your senior leadership team and down into your organization to understand this is who we are, this is where we are, this is what we are right now. Focus on the principles that underpin success. And we're going to be talking about that in a lot more detail in the weeks and months to come. Consciously limit your options and narrow your focus. The single most effective way to create momentum is to do a few things really, really well. Eradicate the mistakes everyone makes. And leave time to make your own mistakes, right? We're in the business of taking risks. But what we want to do is to eradicate the mistakes that are going to undermine that and stop us from achieving the vision we have. And then lastly, put the right people in the right roles at the right time. This might seem difficult to have those conversations, but believe me, this is a very, very powerful strategy if deployed correctly, which will allow you to keep your very best people all the way through till scale and realization. Over the coming weeks, months, and years, frankly, we play a really long game. We're going to be pinning our ears back and talking about the 1 to 100 journey. We're going to be sharing the methodology that we use to support our portfolio companies. We're going to be breaking down the start, build, and scale journey into the core principles and the core mistakes. We're going to be sharing some case studies, and we're at the beginning of the journey of rolling this out to you. I hope you will find this as useful to consume as we have felt as useful to create. Thank you.